What was moving the market? Julia Lee joins us from Bell Direct. Julia, always good to talk to you, hear your views on what was moving the markets. Now, we did so well at the start of those offshore leads really helping us along, but what was behind the sell-off in the afternoon?
Friday, what a day on the Australian share market. As you mentioned, the leads going into our market today were pretty good. We saw a good night on Wall Street on Friday with the Dow up by 1.2%. The jobs numbers coming in ahead of expectations, base metals higher, and yet by the end of the day, the Australian market really struggling. And today was a great example of what can happen when the Australian market reaches a ceiling or a resistance level on the market. If I bring up the 52-week chart of the S&P ASX 200 index, you can see that this is a previous ceiling on the market at 4,350 points or around that area. We tested it in October, November 3 times. We've been testing it throughout the past week. Once again today we tested that level and we bounced off around about those levels, and the market really pulled back after reaching that ceiling. So another psychological point on the Australian share market. The Australian share market didn't manage to beat that psychological level, and we saw the market being sold off. We did see all sectors in the morning starting off on positive territory, so it was a pretty good start for the market. But by the end of the session, we did see 4 sectors actually in the red. So we saw the energy sector, the material sector, the utility sector, as well as the financial sector, all losing ground. On a more positive note, though, property was the star performer. It was up by more than 3% during the session. We saw Goodman Group, the leader there, up by a massive 14.6% after coming back online after completing the institutional component of its capital raising. Crane, though, not having a good day. Its shares down by about 9% after its full-year result. Its outlook still looking a little bit cloudy because it does deal in industrial as well as building products, both quite difficult areas at the moment. Fortescue down by 4.8% after its full-year result. Rio Tinto also coming under pressure because of the tensions with China at the moment. I guess one standout was Village Roadshow. Its shares up almost 14% on news that one of its major shareholders could be looking at privatising the company, so that was quite supportive. But altogether, it ended up being a bit of a disappointing session for the Australian share market.
Yeah, it was, wasn't it? Now, what did you make of Fortescue's results? The market didn't seem to be very impressed.
This one's a little bit hard to digest. If you have a look at Fortescue Metals' result, its net profit result came in at $508 million US. Its underlying profit came in at $342 million US. Now, a couple of, reasons why it's a little bit hard to digest is, number one, they've moved from using the Australian dollar as a denomination to the US dollar, so a bit of a conversion there. Also, if we break down the numbers, there's a $1.1 billion revaluation of its subordinated debt upwards, and so just trying to figure out where that fits into things. If we have a look at the production targets, what Fortescue's trying to do and what it's achieved, I guess its first milestone is ramping up its one of its major milestones is ramping up its production target to about 45 million tonnes per annum. If we have a look at how many tonnes were mined, 31 million for this particular financial year. If we have a look at Fortescue's share price, this is the 52-week share price, and you can see we've seen a substantial recovery in its share price. It had a low of $2.18 back in March, and we've seen the shares finish at about $4.16, so almost doubling in price in the last 4 or 5 months. So a pretty good result by Fortescue comparing 2009 results. But today you can see that after its result came out, its shares sharply sold off, so its shares down by about 5% today.
Now, no read on Bendigo's shares, of course, as it undertakes that capital raising. What's likely to be in store for the company?
Bendigo has come out with a capital raising, $300 million at a discounted price of $6.75, so around about a 16% discount to the last traded price. I guess that type of discount would make it attractive for investors to get back in on the stock. But Bendigo and Adelaide Bank in the past week has been coming out with a bit of bad news. It's firstly downgraded its expectations for full-year profit, which it's come in today and come in line with expectations. Not surprising that it only gave guidance last week, but also saying that a number of provisions have increased. One, its provisions for its exposure to Great Southern Plantations increasing by more than $20 million. Also a $14.4 million charge because of asset deterioration in the property sector. So it does look like Bendigo and Adelaide Bank have been hit hard. It will be interesting to see how the shares react once they come back online, because they have been trying measures like asking staff to take 10 days of unpaid leave a year. So Bendigo and Adelaide Bank, a lot of bad news in the past week. Now this capital raising, it will boost their Tier 1 1 capital ratio. Hopefully all the nasty surprises are out in the open now, and it's a clear line forward for Bendigo and Adelaide Bank, but a $300 million capital raising, so shares not trading today.
Julia, good to talk to you as always. We'll check in with you again tomorrow. Thanks for that.
Thanks, Friday.